I'm Lee Stone, and this is your UFXBank Week in Review. Today, we will be covering some of the major financial events of the week, and we will provide some technical analysis for the week to come. But before we begin, let's cover last week's risers and fallers. The Euro-US dollar pair went up almost 1%, beginning the week at 129.07 and finishing at 130.39. The British pound rose 1.7% through the week against the dollar, opening the week at 154.23 and closing at 156.91. The US dollar Japanese yen started the week at 87.44 and fell to 86.44, losing 1.15%. The US Canadian dollar pair began the week at 103.63 and dropped to 102.93 on Friday. Gold fell 0.7% to $1,180.90, while oil traded heavily in the week but finished relatively unchanged at $78.95. In the news this week, Friday saw the release of the U.S. economic growth forecast, which declined from first quarter predictions. The U.S. dollar dropped to an 8-month low against the yen on Friday amid concerns that the recent GDP data indicates a slowing momentum in the U.S. economic recovery. The euro hit an 11-week high against the dollar, capping the month of July with a 6.7% increase, its best month since May of 2009. For more on these events, let us go now to analyst Martin Smith. Martin, how are you?
Very well, thank you, Lee.
So can you tell us about the impact of the U.S. growth forecast?
Well, I'll certainly try. The annual growth forecast for the U.S. economy dropped to 2.4% after the second quarter from 2.7% in the first quarter this year. Now, that means that the economic expansion in the U.S. is probably decreasing and has raised concerns that the economic recovery is cooling. Now, this information is reinforcing expectations that interest rates will not increase well into next year. US stocks had their best month in a year, which is promising news, but analysts are tempering their excitement because the 7% gain in July that the S&P 500 and Dow experienced was on low volume trading, and it followed an almost 14% decline through May and June. So for now, we can expect a slow and steady recovery for the US, which is likely to mean more of the same.
So what about the US dollar's drop against the yen?
Well, obviously the data on the GDP forecast had some effect on the dollar's decline, but I would say that the fall on Friday was mostly driven by month-end selling from Japanese exporters. That being said, the state of the US economy remains troubling. The 8-month low against the yen and the 11-week decline against the euro in the month of July is not great news for the dollar. The risk of deflation has increased since the beginning of the year, and as long as US yields remain in a downslide, we're likely to see a continuing trend.
As long as we're covering the dollar, could you provide us with some technical analysis on the Aussie-US dollar pair?
Yeah, sure. The Aussie-US dollar had increased to around 0.9080 at the beginning of last week, but it then fell sharply under 89.50. It had a second rise, which also stopped at around 0.9080, making this a new resistance line. Now, the pair finally closed at 0.9043, which is just above the psychological line of 0.90. The Aussie-US dollar is bound to the zone that it was trading in the past week. That's between 0.8950 and 0.9080. Now, looking down the chart, the next line of support is at 0.8870. That figure capped the pair twice in June and July. After this line was broken moving upward, the Aussie-US dollar moved well past it, making it a strong line. Now, 0.8735 was the low point in December and has also been a recent support line. This is followed by 0.8660, also a minor support line in recent months, and then by 0.8567, which provided support many times in the past year and also served as a resistance line in May. Looking up above 0.9080, the next resistance line is quite close at 0.9135. This was a support line when the Aussie was trading higher. Above 0.9220 had a similar role, and it works as a resistance line as well. And going even higher to 0.9327 held the pair 5 times in the past year and provides a strong resistance. The next lines are close to 0.9366, which was a peak in April, and 0.9405, which was the highest level in 2009.
Thank you for that, Martin. Today's Ask the Broker question comes to us from Vincenzo Romano of Bologna, Italy, who writes, when the U.S. stock market goes up, the value of the dollar decreases. Shouldn't we see it the other way around?
Well, yes, this is an interesting question. In most economies, this isn't in fact the way it works, of course, but if the stock markets of that country are moving up, the value of the currency moves up. When the European stock markets increase, it bodes well for the euro, just as an increase in the London exchange, of course, boosts the pound. Now, for some time now, we've been seeing an inverse reaction with regard to the US dollar. This is essentially caused by risk appetite. Investors are selling bonds and loans and putting the money into stocks or riskier investments. Now, when the markets slump, investors' risk appetite turns to risk aversion, and they place their money, of course, where it's safe. US bonds and loans are big indicators in the value of the dollar. So, as investment in bonds and loans increases, so does the value of the dollar. Now, since the dollar is yielding so little right now, these safe options are operating strictly as safe havens. When interest rates eventually increase, we're likely to see a corresponding movement between US stocks and the US dollar. Just don't count on it happening anytime soon.
All right, well, thank you very much, Martin.
Okay.
Well, that's all the time we have for today. We hope you enjoyed this week's review, and we hope to see you next week. Until then, be sure to visit us at UFXBank.com for simple, safe, and secure trading. Also, you can follow us on Twitter and Facebook. To submit your questions to our weekly broadcast, please email your questions to Martin Smith at askthebroker@UFXBank.com. I'm Lee Stone, and this was your UFX Bank Week in Review.